There we go. That's working now. We got. So, why is that so weird? Okay, that's working now. We got. So, why is that so weird? That's working now. We got. So, why is that so weird? Okay, perfect. So, these are the roadmaps for the CFP exam. I need to know all of these. Um, so let's get it started. So, college education funding strategies. The funding years, which would be before college, your options. Hold on. Your options are UGMA and UTMAs. These are subject to kiddie tax for children under age of 24. Double E bonds. Parents own the bonds, so they will not work in a UGMA or UTMA account. Coverdell Education Savings Plans, ESAs, limited to $2,000 a year contribution total. Section 529 plan, QTP, Qualified Tuition Plan, available in two types, college saving or prepaid tuition plans. You can do $18,000 contribution per year per child. You can do that 5 times. You can multiply that by 5 times for $90,000 in a year. But this is, you cannot do that every year. You can do that for the next 5 years, if that makes sense. It's just 18 times 5. So grants and loans, you can only do one of these paths. If you're wealthy, you can do a parent loan. Undergraduate students, wealthy parents are a plus loans. Poorish, less than $70,000 of income, you can do Pell Grants, Supplemental Education Opportunity Grant, subsidized Stafford student loans, or subsidized Stafford unit loans. This is during the college years. Tax credits, distributions, and withdrawals cannot be combined for the same child or expense. You can only use one. The American Opportunity Credit, $2,000 plus 25% of the next $2,000. Maximum is $2,500 tax credit. Magi phase outs on the tax sheet. First 4 years of college only. Lifetime learning credit, $2,000 max. Any higher learning institution, undergrad, grad, continuing ed. Magi phase outs on tax sheet. Coverdell withdrawal must be used before student is 30. Magi phase outs on tax sheets. 529 QTPs, there's no Magi phase outs. Graduate years, your options are a Fulbright scholarship, a Stafford loan, 529 distribution, or Coverdell, same coordination, rules above apply. So legal liability. So intentional tort, deliberately performed act that is an infringement of rights, e.g. assault, libel, slander, or false arrest. Unintentional torts, negligences, or carelessness. Over here on to the left, we have negligence. A negligence would be an attractive nuisance, swimming pool or a vacant lot. If someone comes in and drowns in your swimming pool, you're liable for that. If people are in your vacant lot and they're partying and they get drunk, you're liable for that. Negligence per se, if you violate a statute. Strict liability. Example, product liability. Absolute liability. Example, keeping chimpanzees in your house. Vicarious liability. This would be principals responsible for their agents. So, owners responsible for their employees. Defenses, assumption of risk. If you're going to go skiing or skydiving, you're assuming that risk upon yourself. Contributory, jaywalking or drunk driving. You contributed to that act. Comparative, 20% negligent. B is 80% negligent. A last clear chance example would be road rage. You had a time window, a window of time to get out of the accident, but you didn't. Life insurance policy types. So short-term short-term need, low cost, no cash value, term insurance. Annual renewable term, ART, premiums increase annually. Level term, premiums level for term of years. Re-entry, requalify for low cost premium through abbreviated underwriting. Decreasing term is decreasing death benefit with a level premium. You also have mortgage protection with that. First to die, joint life, buy, sell, or mortgage protection. Long-term needs, higher cost cash value. For low risk tolerance, insurer controls investment return, assets part of general account. We have whole life, universal life, and single life. Whole life, straight whole life, you get lifetime payments. Limited pay whole life, payments for a specified number of years. Universal life, premiums and the level of protection can be adjusted up or down. Single life application, death of the primary income provider, need to pay off debt or education expenses. Over here on the right, high risk tolerance, client controls investment return, assets part of separate account. We got variable life, premium is fixed. Variable universal life, premiums and the level of protection can be adjusted up or down. We have survivor life and second to die. A would be for estate liquidity and B would be for lower cost. Over here we have universal versus variable life. Level death benefit only. B, increasing death benefit plus cash value. So death benefit increases and there's a cash value that increases. Employee is insured. Endorsement method, employer is the owner. Employee is not a shareholder. Death or policy surrender, employer retains the cash value of the policy or premiums paid if greater. Employee's beneficiary gets balance of death benefit. The endorsement method, employer pays the premiums paid or cash value for the life insurance policy, refunded at death or surrender. Collateral assignment method, employee is the owner, employee is the shareholder, employee assigns the policy, death or policy surrender, employer receives premiums paid, employee gets a balance of cash value, a surrender, or beneficiary gets balance of the death benefits. Employee is charged with table 2001 insurance cost. Life insurance policy, the balance of any death benefit, and the beneficiary receives income tax free. To determine R squared is the coefficient of the correlation coefficient, is the square of the correlation coefficient. If R square is greater than 60, a high R square is an indication of a diversified portfolio. If it's higher than 60, look for the highest positive alpha, Jensen number. If Alpha Jensen is not a choice, then select the highest trainer number. Alpha, or the Jensen number, and the trainer keys. Risk is measured in terms of beta. Volatility contains systematic risk. R squared is less than 60. A low R squared indicates a non-diversified portfolio. We are going to look for the highest Sharpe number. Sharpe keys. Risk is measured in the terms of standard deviation. Variability contains systematic and unsystematic risk. The 1040 tax calculation income tax, this is for AGI. Gross income, less above the line adjustments is your AGI, your adjusted gross income. Less below the line AGI, you get your taxable income. Multiplied by appropriate tax rates, you get your taxable calculation, minus the credits, less credits plus other taxes, you get your tax liability. Less quarter payments and withholding, net tax due or refund. Business entities. Business is profitable. You got C corporation keys. Separate tax entity. Dividend received deduction. Personal Service Corporation, PSC. Flat tax at 21%. If a business has losses, we go over here to the left. We have risk-free entity. Sole proprietorship keys. Pension plan KEO. 100% of medical, dental, and long-term care insurance deductible for owner. Lack of continuity. Partnership keys. Pension plan KEO. 100% of medical, dental, and long-term care insurance deductible for owner. Lack of continuity. Losses up to basis. You can only have losses up to your basis as the partnership. If you own 50%, you can only have that 50% basis, whatever that number was. Risky entity needs to be limited liability. S corporation keys, pension plan, 100% of medical, dental, and long-term care insurance deductible for greater than 2%, greater than or equal to 2% owner. Losses up to basis. Special requirements, no more than 100 shareholders, no one class of stock, no preferred, must be a domestic corporation. Shareholders must be U.S. citizens or residents. All shareholders must consent to the election. Limited liability companies. Limited liabilities like a corporation. Losses up to basis like a partnership. Limited partnership keys. Limited partners cannot actively participate in the business. Losses up to basis. Charitable deduction limits. Who is receiving the donation? Charities. What kind of property am I donating? Cash. Value of donation, cash. Overall, write-off, cash. This year's write-off, 60% of AGI. If it is a cash donation, you can do 60% of AGI. Long-term appreciated property, value of donation, basis or fair market value. Overall write-off, basis or fair market value. This year's write-off, if it's basis, you got 50% AGI. From the fair market value, 30% AGI. Ordinary property, value of donation is the basis. Overall write-off, you write off the basis. This year's write-off is 50% of AGI. Loss property. Value of donation is the fair market value. Overall write-off, fair market value. This year's write-off is up to 50% AGI. For lost property, you can write off 50% of AGI, not 30%, because it's a lost property. Charitable deductions must be itemized because they are reported on the Schedule A, deduction from AGI. Types of retirement plans. Defined benefit pension, qualified ERISA PBGC. Vesting schedule, administration costs exempt from creditors, integrate with Social Security. Favors older employee and owners, 50 plus. Guaranteed retirement benefit amount, can meet a set retirement objective. Requires a stable, very stable cash flow. Past service credits allowed. Cash balance plan, a pension plan, a pension type of DB plan. I need to get a drink. Okay, for favoring younger participants, uncertain retirement benefits, defined contribution, qualified plans, ERISA, vesting schedule, administration costs, exempt from creditors, integrated with Social Security, money purchase pension, keys, up to 25% employer deduction, fixed contributions, stable cash flow needed, target benefit pension, up to 25% employer deduction, fixed contributions, stable cash flow needed, favors older employees, profit sharing plans, up to 25% employer deduction, flexible contributions must be recurring and substantial, 401k provisions, 23,000, FICA hardship withdrawals. Simple 401k is exempt from creditors. See Simple for additional information. Stock bonus plan keys, up to 25% employer deduction, flexible contributions, 100% of the contribution can be invested in company stock. ESOP cannot be integrated with Social Security or cross-tested. Other retirement plans, no vesting schedule, lower administration costs, simple IRA keys. For small employers, 100 or fewer employees. Requires an employer match, immediate vesting. Salary reduction limit up to $16,000 FICA. Company cannot have another plan. If you have a simple, you cannot have another plan. SEP IRA keys, no salary deferral, up to 25% contribution for owner, W-2, up to 18.59 contribution for self-employed. Account immediately invested, can be integrated with Social Security. Eligibility, special eligibility, 21 plus years old, paid at least $750 and worked 3 of the 5 prior years. A SAR SEP keys may have up to 25 employees, and 50% of the eligible employees must defer. Must be in existence before 12/31/96, grandfathered. Salary deduction limit 23,000 FICA. New employees may participate in SAR-SEP if it was established before 97, 1197. 403B keys, TSA TDA for 501c3 organization and public schools. Subject to ERISA only if the employer contributes. Salary reduction limit up to 23,000 FICA. Employer contributions may be subject to vesting schedule. Note, 457 plan operate as non-qualified deferred compensation plans. KEO plans are qualified plans for the self-employed. They may be offered as either defined benefit or defined contribution plans. Withdrawal converted Roth assets. Meets 5-year holding period, no income tax, no early withdrawal penalty. If it fails to meet the 5-year holding period, is there special needs special purposes? If you're 59 and a half or older, death, disability, first home purchase up to $10,000, medical expenses, medical insurance premiums, unemployed, substantially equal periodic payments, higher education expenses, or birth and adoption. If there's no special purpose, if there's a special purpose, there's no income tax, there's no early withdrawal penalty. If there is no special purpose, there is no income tax, but there's a 10% early withdrawal penalty. Withdrawal Roth earnings, converted or contributory Roth, fails to meet the 5-year holding period. Special purposes, 59 and a half or older, death, disability, first-time home purchase up to 10,000, medical expenses, medical insurance premiums while unemployed, substantially equal periodic payments, higher education expenses, birth and adoption. There's income tax, no early withdrawal penalty. If there's no special purpose, income tax, 10% early withdrawal penalty. If it meets the 5-year holding period, we're going to go down here. Is there a triggering events that qualified? 59 and a half or older, death, disability, first-time home purchase up to $10,000. No income tax and no early withdrawal period if any of those happen. Remaining special purposes, medical expenses, medical insurance, premiums while unemployed, substantially equal periodic payments, higher education expenses, birth and adoption. You have no income. You have income tax, but no early withdrawal penalty. If there's no triggering events, there's income tax and a 10% early withdrawal penalty. Required minimum distributions. If the owner dies beyond RBD, spouse only beneficiary, roll over IRA assets into his or her IRA and take distributions based on his or her own required beginning date. Keep the assets in the owner's IRA and take distributions based on the longer of spouse's single life expectancy. No beneficiaries. See below. Owner dies before RBD. Spouse only beneficiary. Roll over IRA assets into his or her IRA and take distributions based on his or her own required beginning date. Keep the assets in owner's IRA and take distributions starting when the owner should have reached 73, based on the spouse's life expectancy. Non-spouse individuals, children and grandchildren, other individuals qualified trust, take distributions within 10 years. Stretch eliminated. Note, portions of the above chart are crossed out because it's unlikely they will be tested. RMDs are still permissible for IRA owners dying before 1/1/2020. Named beneficiaries may take out distributions over the beneficiary's lifetime. So what is this chart even saying? If they die beyond, the only difference is owner dies beyond, you keep the assets in the IRA and take distributions based off of the longer of the spouse's single life expectancy or no beneficiaries. What does that mean? If the owner dies before RBD, start when the owner would have been 73, based on the spouse's life expectancy. Non-spouse, you take it within 10 years. I think I understand that. Estate tax form, key elements of the 706. Gross estate. Gross estate includes the following: all probate assets, singly owned fee simple assets, tenancy in common, estate as beneficiary, community property, all non-probate assets, JTWROS, and tenancy by entirety, life insurance, general powers of appointment, gift taxes paid within 3 years of death. Note, generation skipping transfer tax paid within 3 years of death are not added back into the gross estate. So you take the gross estate, you subtract the funeral expenses, administration expenses, debts, and taxes, and casualty losses. Then you get the adjusted gross estate, AGE. Then you less marital and charitable deductions. Then you get taxable estate, plus adjusted taxable gifts, amounts exceeding annual gift tax exclusion. Then you get your tax base. Then you subtract less estate tax deduction, 13,610 for 2024, remainder of 40%. Tentative tax, less gift taxes paid, and then you get your net estate tax. Okay, tax implications for powers of appointment estate. A special power is exercisable only with the consent of the creator and or of the power. Let me restart that. A special power is exercisable only with the consent of the creator of the power or a person having a substantial adverse interest, not a general power of appointment. A power that is limited by ascertainable standard relating to health, education, maintenance, or support, HEMS, determined by the power holder, not a general power of appointment. Tax implications. No gift tax, no estate tax. A general power allows the holder to exercise the power in any manner he or she wishes. The power holder may appoint the property to him or himself, his or her creditors, his or her estate, or the creditors of his or her estate. A general power is virtually the same as the outright ownership. Power is exercised, released, or lapsed. You get tax implications. Gift tax implications are taxed, and estate tax implications are taxed. Powers exercised, released, or lapsed with a 5 or 5 power. Tax implications. No gift tax implications. Estate tax greater of 5% or $5,000 is taxed. ABC Trusts Estate. Revocable trust with an ABC provisions. Gifting using crummy provisions into a life insurance trust. You can also move it down here. If the first spouse dies, you can put into an A trust. Assets passed by marital deduction, no tax. Or it can go into a C trust. Assets passed by marital deduction, no tax. A B trust. Assets passed using the 13,610,000 exemption, no tax. Life insurance trust. First spouse dies. Death benefit passes tax-free into a life insurance trust. They can go into B trust. Assets pass 13. Life insurance trust. Second spouse dies. Assets pass to a trust beneficiary. You can have HEMS and 5 for 5 provisions for C, B, and life insurance trusts. For a B trust, once the second spouse dies, assets pass to a trust beneficiary. C trust, spouse dies, subject to estate tax, assets pass to trust beneficiary. A trust, second spouse dies, subject to estate tax, assets pass to second spouse's beneficiary. A and C trusts are for your spouses. B and life trusts are for anybody. Gifts to minors. Future interest Gift of 25(3)(b) trust, bad boy. Interest only distributions. Interest distributions only. Must be applicable. Credit to fund. Income payout may be subject to kitty tax. Gift of a present interest. Subject to kitty tax rules UGMA. Must be funded with cash type assets, EE securities, municipal muni bonds. Normally distributed at age 18, can be included in custodian's estate, cannot be testamentary. UTMA can be funded with any type of asset, including real estate. Normally distributed at age 21, can be included in custodian's estate, can be testamentary. UTMA can be testamentary. Trust rate 37% or greater than or equal to 15,000 plus. 2503C trust, children's trust, can be funded with any type of asset. This is why people like using this for real estate. Normally distributed at age 21. Costs set up to set up and maintain legal and accounting. Can be included in grantor trustee's estate. Section 529 college savings plan. Section 5 invested in specific bonds, flexible distributions, lump sum gift of $90,000. Donor can retain control. K-12, $10,000 per year. $10K towards student loan person. Charitable contributions and transfers. Income to donor until donor's death. Income tax deduction based on present value of remainder not subject to gift tax at donor's death paid to charity. If you need a trust, you can do a CRAT or a CRUT. So if you need income to donor until donor's death, you're going to want to either do a CRAT and you want to put it in a trust. It's a CRAT or a CRUT. CRAT 5%, no additions, payments fixed, lifetime or term certain, payable to any charities, 10% ending value. A CRUT, additions allowed, payments variable, assets revalued annually, payable to any charity, 10% ending value. If you do no trust needed, you can do pooled income. Additions allowed, payments variable, based on fund income, payable to a specific charity. Charitable gift annuity. No additions, fixed lifetime income, payable to a specific charity. Charitable deduction based on gift less than annuity. If you need income to the charity, you would do a CLAT or a CLUT. Income or estate tax deduction after a period of time paid to a non-charitable beneficiary. You can do a private foundation, 5%. 30% income tax deduction, payable to a charity or a private individual. Can continue for an indefinite time period. Note, amounts in the parentheses indicate minimum amount the corpus must be paid out each year. So in parentheses, CRAT and CRUT, 5%. CLAT and CLUT is 0%. Private foundation, 5%. Life insurance inclusion in the decedent's estate. Decedent insured is you. You own the policy and you die. Death benefit is included in your estate. Your spouse owns your policy. You gift to him or her and she dies within 3 year or transfer. Death benefit is included in your estate, 3-year rule. You gifted it to him or her and never changed the beneficiary, your estate. Death benefit is included in your estate. If you sold the policy, nothing is included in your estate. No 3-year rule. Someone else insured, your spouse. You own the policy on your spouse. Replacement cost is included in your estate. term unused premium whole life minus interpolated terminal reserve plus unearned income. No 3-year rule. You gifted your spouse's policy to your daughter. Nothing included in your estate. No 3-year rule. These two situations will cause the value to be included in the owner's probate estate. Intra-family business transfer techniques. Estate. Property owners need income. Pigs need income. Installment sale. Sale of property at fair market value is in exchange for payments. Present value of remaining payments is included in the owner's estate. Property is secured. Gain is capital gain. Do not use if property is subject to recapture. 1245 depreciation. Self-canceling installment note. Skin. No value is included in the owner's estate. Gain is capital. Assets can be depreciated. Interest can be deducted. Higher payout than installment. Private annuity. Sale of property is in exchange for periodic payments. There is no value in the included owner's estate. Property is transferred, exchanged for a promise. Taxation to the seller. All the gain which would have been recognized over the life of the annuity will now be taxed in the year in which the private annuity is established. Grantor retained annuity trust, grat or regret. Irrevocable trusts that allow the grantor to make gifts of property while retaining an income interest. At the end of a term, corpus is distributed to a remainder person. The value of the gift is discounted due to the retained interest. Owner must outlive the term of the asset, or the term of the asset is brought back into the estate. Best asset likely to appreciate. Retained interest trust, grit, no family members. Over here on the right, we got property owner wants to gift assets and or income to family members. You would do partnership, S corp, gifting shares. Family members receive conduit income. Ineffective if a child is under age 24 because there's kiddie tax. Business entity must be capital sensitive. Not available if business is service related. Family limited partnership, an FLP. Gift interest to limited partners to reduce the state. Qualifies for various valuation discounts, allowing for a lower gift tax. General partner maintains control. Gift leaseback. Gift of the fully depreciated property. Lease payments are a business deduction, income to family members. Do not use if the child is under the age of 24. Qualified personal residence trust, a QPERT. An irrevocable transfer of a personal residence. At the end of a term, the residence is eliminated from the grantor's estate. The value of the gift is discounted. The owner must outlive the term, or the asset is brought back into the grantor estate. Post-mortem elections for estate liquidity. Section 303, stock redemption. Business must be incorporated, closely held stock. Value of stock must exceed 35% of decedent's adjusted gross estate. Amount of stock redeemed as the capital cannot exceed the sum of the estate taxes plus the administration expenses. Installment payment estate taxes 6166. 6166 property must be sold in a sole proprietorship, partnership, or corporation. Aggregation is allowed if more than 20% interest is in each business. Interest must be carried on as the day of the death. Value of businesses or business must exceed 35% of the decedent's adjusted gross estate. So it's got to be a big family business that a lot of wealth is tied up into. During the first 4 years of 14 years, you can pay interest only on taxes due. The interest rate will be 2% on the first $1 million indexed to 1.850 million in 2024. The 2% is not deductible. So you don't have to pay the taxes for 14 years. You just pay the interest on the first 4 years, and then it just delays the taxes. Estate tax reduction. Special use valuation 2032A. Real estate used for farming or closely held business. Several rules that qualify. 50% of the gross estate must consist of real and personal property. 25% of the gross estate must consist of real property. 750,000 reduction in the descendants' gross estate. 1.39 million in 2024. Must be qualified use 5 out of 8 rule before death, 10 years after death. And those are the roadmaps that I have in this Discord. So I am going to stop this stream and probably